because of the tax exemptions that we were getting put in place at closing, our effective cap rate was a post property tax exemption cap rate. So we were able to close and day one have an improved cap rate because we weren't paying property taxes day one. So our improved cap rate, if you will, day one was 6.5%. So without doing renovations, without taking a lot of operational risk, we were already achieving a positive spread between our cap rate.
What was the debt interest rate versus
Right.
the going in cap? And then where do you see, efficiencies growing, and kind of talk us a little bit about that.
Yep. So the debt portion, we generally focus on 7-year, depends, but 5, 7, or 10-year fixed rate debt. And on these deals, we opted for 7-year fixed rate debt through Freddie Mac. And Fannie Mae and Freddie Mac, for those that aren't familiar, are government-sponsored enterprises that are sources of financing that are unique to multifamily. One thing that really helps multifamily out is that you have essentially government-backed debt, which provides almost guaranteed liquidity in the housing market. This is super beneficial because we're able to tap into the best interest rates, the best deal terms available on the debt side. So on these deals, we locked in 7-year fixed rate debt at around 6%. And because of the tax exemptions that we were getting put in place at closing, our effective cap rate was a post property tax exemption cap rate. So we were able to close and day one have an improved cap rate because we weren't paying property taxes day one. So our improved cap rate, if you will, day one was 6.5%. So without doing renovations, without taking a lot of operational risk, we were already achieving a positive spread between our cap rate and our interest rate, which many savvy investors these days are preaching the importance of positive leverage. That's what they call it. It's positive leverage when you have a cap rate that is higher than your interest rate, which helps you have higher cash flow and lower risk.
Excellent. Yeah, I love that. Great job. And now let's talk about a little bit of a tax flow here. So are you guys planning on doing a cost seg study in depreciation? And how are you structuring your syndications with your investors?
Yeah, absolutely. So as standard, I'm sure for you as well. For us, we do cost segregation reports, and then we elect bonus depreciation. We have historically elected bonus depreciation, which is sunsetting, but also they're reintroducing a bill now, as I'm sure you've seen, to bring 100% bonus depreciation back. So those are the things that we always opt for. And these deals, even though they're more unique as far as their affordable structure, they're no different. So we still elected for the cost seg and the bonus depreciation, which will benefit our investors on their 2023 taxes, because we'll be able to have accelerated losses that they'll be able to utilize to offset income in their portfolio. So
perfect.
That's something that we typically do. And then another thing, just jumping ahead a bit, are 1031 exchanges. So 1031 exchanges, in my opinion, are one of the biggest builders of wealth. I think it's just such a hack, and it really makes real estate stand out from the rest of the crowd when it comes to your options as an investor. And a 1031 exchange, as I'm sure you guys have talked before on this show, is a tax deferred exchange where you're able to sell real estate, and then without paying tax, you can defer the gain into a new piece of real estate and essentially defer paying tax, and you're able to compound your equity more quickly because you don't have tax drag along the way. And so for us, 1031 exchanges are a big part of our business. We look to 1031 exchange upon sale of an asset and then invite our investors to 1031 exchange with us into the new deal. But in addition to that, we also have 1031 exchange investors who they are selling property, and they might be looking to roll $1 million, $2 million or more into a deal with us where they can be a minority owner with us through a tenancy in common, which is very similar to what you mentioned early on in the show, which is the DST structure as well.